So allow me to formally welcome you to this event. We're really excited to be sharing with you the key proposals in the second exposure draft of INPAG, International Non-Profit Accounting Guidance, so that you can give us your feedback. My name is Samantha Musoke, and I'm the IFR for MPO Project Director for Humentum. I'm based in Uganda, and I know many of you have received an invitation or email from me, so thank you for your positive response and coming today. Today, I'm delighted to be joined by Paul Mason, who is a CIPFA associate. That's the Chartered Institute of Public Finance and Accountancy. Paul has been very much involved with the drafting of the section that we'll be looking at today. So he's exactly the right person to answer our questions and also just add color and context in terms of some of the decisions that have been made. So welcome, Paul. I hope you are unmuted. Maybe Brian, you could help me unmute Paul if I muted him by accident.
Hello, Sam.
So I hope that many of you have attended earlier events and that you already have some awareness about the IFR for MPO project and INPAG. So rather than introduce it in every webinar, we have two videos, one about the projects and one about the INPAG that have been shared with you in emails and are available on our website and YouTube. So we trust that you've already familiar with the basics. Today's webinar is part of our series covering the main themes in Exposure Draft 2. You can register for future events and also view resources from previous events from the website there, ifr4mpo.org/events. We really are keen to hear your thoughts and feedback. The perspective of people working in the sector, as well as donors and auditors, the accounting profession all around the world, are really essential to making sure that the guidance is relevant, it's user-friendly, credible, fit for purpose, so that it can be widely used. The project started back in 2019, and we have had input from volunteer advisors and experts to reach the point of sharing this exposure draft with you. And now it's a period of public consultation. So the purpose of today's 1-hour webinar is to explain the proposals and for you to have the opportunity to ask questions and seek clarifications on the proposals being made, as well as share your comments, your opinions, and your feedback. And at the end of the webinar, we'll also tell you how you can submit a formal response to the consultation, should you wish to. So here's the flow for today's session. We've already finished the introduction. So now we're going to do something a bit unusual for a webinar, but what we've been doing all along through this series. We're going to watch a video on YouTube that we've prepared in advance to explain the proposals. It's about 9 or 10 minutes, depending on the language. So we'll put a link in the chat. I hope that's there. I can't see, but I trust it's there. What it is, it's the same video in English, French, and Spanish. So it means that everybody can watch it in their preferred language at the same time. If you get adverts on YouTube, please just click through. Sorry about that. And just so that you know, there's nothing that's advertised on YouTube is particularly endorsed by us as a project. So as you watch the video, please think about how the proposals apply in situations that you're familiar with in your context. Please type any questions that come to mind in the chat as we go along. Please use the Zoom chat for questions in English and the Microsoft Translator app in French or Spanish or any other language. And then after the video is finished, we'll come back together in the Zoom room and respond to selected questions. Now, for this event, due to the size and the time and language considerations, we're only going to be able to take comments and questions in writing. So for now, let's everybody follow the link and go to watch the video in YouTube, and we'll come back. Let us know when you finished it, and we'll resume our conversation here in Zoom. Thank you. Great. Okay, so I'm glad that you've had a chance to watch that video. Hope that was useful, and you're able to follow it in your own language and able to find the links and everything. So it's a bit of logistics. And we're really interested to hear your questions and comments. I'm actually going to stop sharing because that way we get to see more people there. I know some of you are logged in as if you're Alfred or Cott. I don't know who the real Alfred or Cott is, but if your name isn't Alfred, please do rename yourself by right-clicking on your square and giving us your real name. Or if you're typing, just tell us who you really are when you ask a question. That would be very helpful for us. We have had some questions submitted in advance, but I thought what we'd actually start with is a quick poll to get a temperature sort of check. So the poll's up. There's just two questions. The first is really, how big a change would it be for the NPOs that you're familiar with to actually do inventory accounting at all? Maybe you're not failed to launch. Oh, let's try again. Relaunch. There we go. Hopefully you're seeing that now. The first question is, how big a change would this be for NPOs that you're familiar with? Maybe they're not actually doing inventory accounting, or maybe they are. I just would love to get a sense of how much of a change it would be. And the second question is about this separate new way of measuring inventory if it's held for use or for distribution. So if it's not being held for sale, we've got a new way of measuring, which is about the lower of replacement cost or net realizable value. So again, we'd love to have your feedback. Is this type of stock that NPOs hold, it's real stock, it's medical supplies or food or whatever it might be, but you're not holding it to sell it, you're holding it to use it or distribute it? How important is it to have an alternative way to value that kind of stock? I can see the questions are coming in as well, so thank you. That's super. I'll just let a few more of you complete that poll. And I'm looking at the questions in the chat. So about 30% of you finished the poll so far. It'd be great if a few more people can answer the questions in the poll. Otherwise, we will end it there. Okay, so I hope you can see the results on your screen. What we're seeing is that the biggest answer here was 60% was saying this would be a significant change from what they're doing at the moment in terms of the NPOs they're familiar with. 27% said it would be a minor change. They're actually doing already quite a bit of inventory accounting, and 13% saying it'd be a major change. And when it comes to the alternative valuation method for inventory held for use or distribution, 50% saying this is very important, 33% saying this is quite important, and 17% saying it's not important. So that's really helpful for us actually to get a range and see how relevant this is for you. That's really helpful. Great, so I'm going to kick off with some questions. I've got some that I received in advance from the form and some obviously that have come in here. So I'll just start with this one. Paul, how do you measure fair value of donated inventory? So if I'm given some inventory and I don't know what it cost the donor, how do I measure fair value?
So I think this is going to be one of the challenges, and as the video mentioned, fair value is going to be covered in more detail in exposure draft 3. So there will be some guidance there, including some specific guidance on donations. But generally, you're looking at what's the market value for this item. So for a lot of things that may be donated, particularly if they're new things donated to NPOs, then there will be a known market price. How much could you buy it for from a supplier, just from the shops or whatever? So that will be your fair value in those cases. It is going to be more difficult for second-hand items if there is no market for those. That will be more of a challenge, and specialist items as well are more of a challenge. Really, then it's going to question, well, what would be the cost of producing this ourselves if we had to do that? Which again can be difficult to assess in some cases. It's very much going to depend on what the items are. If it's things like vehicles, generally there is a good market even for second-hand vehicles. So yeah, we'll be able to get prices for those. In some countries, there are guides that are issued on market prices for second-hand vehicles. But for other items, specialist items or second-hand items where there isn't that market, yes, it will be more challenging. But I think to see the details of how to measure that, we'll have to wait until exposure draft 3, which is scheduled for the middle of next year, when that guidance will be published and include that specific guidance for donations.
Brilliant. So it can be a bit of a process assigning fair value, a bit of research and work needed if it's not obvious, which is why we have these exceptions, right? So if you've got high volumes of low value, non-unique inventory items, like I think of the shops that sell secondhand clothes, you don't have to go through that process. Which brings me on very nicely to David Hardage's question. So in the exceptions that were in the donations in kind video that we looked at yesterday, which also apply here, it's low value items. How do we define low value? Where's the cutoff between low value and high value?
Yeah, that's always going to be a question of judgment. And I think what you'd be looking at there is taking all of those items together. And this is, particularly if you're looking at what's going through shops, are you looking at material amounts in total rather than I think so you wouldn't expect something of thousands of dollars worth to be treated as low value. If it's thousands of dollars, sort of cars or things like that, very expensive equipment, you would not expect that to be treated as low value. But the sort of thing that's usually donated for resale, the sort of things that the shops that sell those secondhand clothes, secondhand bits and pieces receive, most of that you would expect to be low value. Not always. Sometimes you get expensive items donated or expensive pieces of art, but it is going to be a question of looking at the NPO's overall situation, materiality, and whether those items would be significant to the NPO. I think it's if you're in the shop selling those items, it's something that you would just say, yes, it's one of the usual pieces of one of the usual things we receive, and stick it on the shelves for sale. Or is it something you would say, actually, no, this is special, we're going to have to look at the price for that and treat it separately? I think if it's one of those,
sort of thing where, just like organizations have capitalization thresholds, like anything that's above this, we will consider it an asset. Could an organization have a similar sort of policy that if we think it's likely to be above this level, we'll deem it not to be low value? Is that the sort of thing?
Yeah, and that will need to be set sort of NPO by NPO, because circumstances are different. The volume of things that received is going to be different, but it is always going to be that judgment. And yes, setting a threshold for what you decide is low value, discussing that with your auditors, if you've got auditors, to make sure that they're happy with that threshold, that's going to be the way forward. But it's difficult to give specific guidance on what low value means, because it's going to be so different from entity to entity.
Sure. Well, thank you, David, for unlocking that little mystery. So there's a question here, or comment from Anwar, and I think this might be about a language issue or interpretation issue. So he's saying, what about when an NPO receives stocks/shares, a donation of stocks/shares from an individual? Am I right in thinking that the type of stock we're talking about here is inventories rather than stocks and shares?
Yeah. I mean, I think if you did receive stocks and shares, you'd be treating those generally as a non-current asset, and we're not, rather than as inventory. So it wouldn't be covered as part of this. You would be treating it as financial instruments. They'd be going to a different part of the balance sheet.
Right, so that's a really good one to clear up. In English, we do use the word stocks to mean both, and in this context, we mean inventories. So this whole section is really about inventories. So it's good to get clarity on that one. Jobra in Uganda has a comment, exceptions, and this is what we have. This whole sort of video is around some of the exceptions from the norm. Give liberty for non-profit organizations to record or not record their value. This could cause differences or fraud, where one may use the excuse of low value or otherwise. Why have these exceptions? Why can't we just make it mandatory, make everything recorded? Then there's no wiggle room. We don't have this lack of comparability. We don't have this wiggle room for making excuses and possibly covering up fraud. Why can't we just make it mandatory?
I think there's been a balance that projects been trying to strike between greater transparency, accountability through including everything, measuring things at fair value, etc., and making it workable for some of the smaller NPOs where the difficulties would be recording things. So if we take our donated clothes for resale in a shop, for example, if we don't have the exception, then every time you receive a batch of clothes, you have to fair value every item. You have to put it through an inventory system. You have to record when it's sold to show the expense and that. So you've got the challenges of, well, what is the fair value of each item? Recording them through an inventory system, then recording the expenses as each item is sold. And for many NPOs, many smaller NPOs, that's probably going to be challenging for them, potentially above their capacity at the moment. So to make this workable for those entities, the idea is that we'll allow them to use this exception so that for them it's not it becomes achievable. It is that balance between cost benefits and transparency,
isn't it? It's a real tug of war. And I think if it were made mandatory, we'd have lots of NPOs shouting, why did you make this mandatory? This is too onerous. This is so much effort. This is too much burden. It's not worth it. The outcome isn't worth it for the amount of effort. So that's really where we're trying to balance that. And it's always going to be slightly problematic where you have got options. But this is, I think,
it is.
I've been learning a lot about standard setting on this job because I didn't know anything about it before. But that seems to be one of the big questions, isn't it? It's that balance of cost.
It is. And in terms of fraud, I suspect if you're receiving donated items for resale and some of them are higher value, I suspect the bigger cases of fraud will be that they just never get recorded at all, rather than
recorded at the wrong value.
Recorded at the wrong value, or just treated as low value.
Right. So the low value question is coming up again. Does an organization have any flexibility to use a threshold for low value?
Yeah, I think in practice that's going to be the way that organizations will need to go, determine what the threshold for them for low value is, and make sure that that's been agreed with the auditors so that there's no questions when you get to producing the final accounts, getting them signed off for audit. So yes, discuss that threshold with your auditors first, make sure that they are comfortable with it. But that's going to be the easiest way to implement that exception.
This is kind of the principle-based standard setting, isn't it? So you've got the principle, and then you've got the freedom to apply it in your context. Yeah. Okay, can we come back to these inventory held for use or distribution, which some people said was really important, that we've got this other way of valuing it. So the way is to have the lower of replacement cost and net realizable value. And the video said that net realizable value includes this concept of service potential. So if an item of inventory can no longer be used for its purpose, it could have this loss of service potential. How do you recognize, how do you measure loss of service potential? How could I say, this piece of food is only half as useful as it was? And how does that work in practice? Loss of service potential.
I mean, practice, what you're probably looking for is something that has changed. So you've received the items in, I mean, perishable items, it will be when they go out of date, so that you're not able to use them. But for other things, it's really going to be where there's a change that's happened externally, usually, or because damaged, you would just write it down anyhow. But it's where, okay, there's a loss of service potential because things have changed. So if you've got medical supplies or particular equipment in inventory, and it becomes obsolete, something better comes out, and therefore what the benefits you're going to get is going to be less, then actually that's when you would start to write values down. So you've got your say a medical drug, and actually it turns out that it's less effective than was thought. You actually need to use more of the drug. That's going to have less value at that point. So that would be a loss of service potential, because you're going to what you thought was one dose is actually only half a dose, for example, if the potency turns out not to be what it was thought when it was purchased. So that's the type of thing. But generally, it's going to be where something has happened that makes that inventory less useful than it was otherwise going to be. So it will be a change.
A kind of equivalent to, I can't sell it for as much, but we're not going to be selling it. But it's just that I can't get as much value out of it. Like it can't achieve the good that it was intended to do.
Yeah.
Do you think that will mostly be writing things off down to zero, like it was useful and now it's not, or will there be a lot of 20% less useful kind of adjustments?
I think there will be. I think in a lot of cases it will be things like perishable goods, where it goes from we can use this, but nothing now, and then we can't because it's gone past its date. So that would be a write down to zero. Sometimes the MPO will change how it's operating, what it's doing, and things that it was going to be using, it won't be able to use anymore. The way it's operating, again, that would be down to zero. But there may be some cases, I suspect a minority, where it's actually, yes, we can still use this, but either because things have changed externally or the way the NPO is operating means, we can still use it, but it's not going to give us the value we thought it was originally.
Brilliant. Okay, and what would be the accounting if you've got, and this, am I right in thinking this would be stock inventories, let me use the better word, inventories that we've purchased, but also inventories that we've received as donations. This write down applies to whether we bought it or had it received by donation.
Yeah, if it's been received by donations and it's been recognised because the NPO's not taken advantage of an exception, then you've got it in your inventory as your at its initial cost, or at fair value if it's been donated, and then if you've got that loss of service potential, you would recognize an expense, so debit expense for the loss of service potential, and credit inventory, so reduce the value of the inventory.
Okay, brilliant. So with this idea of sort of perishable goods and secondhand clothes and things is coming up, saying that this is really difficult. And am I right in thinking this is why we have the exceptions? So where you look at the reality of your NPO and you think, oh my gosh, actually ascribing and recognizing and setting up all this inventory system would be insane. That's precisely why we have these exceptions, so that you can look at your reality and think, does this really make sense? Is this an exception we can take care of? So thank you for these comments that are coming in. It's brilliant. Here's another question from somebody also called Alfred Ocott, but I think it might not be the real one. Is it possible to put the amount of small value item inventories in terms of like percentage of total inventory or current assets to avoid subjectivity? So rather than having a complete subjective definition of low value and high value, could it be like, well, if it's 10% of the value of your, or 1% of the value of your total inventory, would that be an approach that could make sense?
It may make sense for that organization. I think it's going to again come down to the organization. Some organizations will have a lot of inventory, some will have a small amount. Some cases that inventory will be a large portion of current assets, in other cases it'll be a small portion. So it's not going to be possible for the project to say it's going to be a specific percentage, but for an individual NPO, it may very well be the case that it says, actually, if this group of inventories is only 10% of our total inventories that we hold for sale. We operate a shop. A lot of the stuff we sell in that shop is new or stuff that we've produced ourselves. That's the bulk of our sales, but we also have the second-hand items that are donated that we also sell. If they're only 10% of it, that's going to be treated as low value. Then yeah, you could use that sort of approach. I think there's always going to be an element of judgment there in terms of what percentage is appropriate for that NPO. I don't think there's an easy way of getting around the fact that there is going to be a judgment involved somewhere.
People want rules. It's so nice when there's a nice clean rule that I can just apply, but actually the rules can cause as many problems as they solve, can't they? So it is going to be judgment based. Okay,
yes.
This brings me to sorry, go ahead.
If you had a threshold which says it's anything below £5,000, there'll be a lot of, or $5,000, there'll be a lot of things being valued at 4,999.
Yes. Okay, so in the video, we've been talking about sort of items like perishable goods or whatever, and there was the consideration that the team considered a new type of inventory recognition of first expired, first out, and then we decided not to. And it said that there's this option to use a separate class of inventories. Can you explain what that is and why would that be useful? When would it be useful for an NPO to create a separate class of inventories?
Yeah, so I mean, classes of inventory are basically items of inventory that are essentially very similar. So you would have potentially all your food, all your medical supplies, etc., as different classes of inventory. And the concern that came actually through the responses to the consultation paper was that for perishable items that are donated, they're quite often donated much closer to the end of their useful life than stuff that would be purchased. So you may be buying vaccines, for example, that have got a 6-month useful life, but items that are donated may have less than a month to go because that's when the donors are trying to get, realize they can't use them and passing them on to the NPOs to be used. So they've effectively, the value of those items may be significantly less because it reflects the fact they've got a short shelf life, may not be capable of being used within that time. And so the suggestion was made that you could have a first expired, first out model, which would take into account that. Now, looking at the how it would work, the view was taken that actually we don't need a separate model for this. We can actually just treat them as a separate class. Classes are essentially items of inventory that have got the same economic impact. And if you're looking at that, well, inventory for medical supplies with the full shelf life that you would expect from something you've purchased has one economic impact. And the impact of donated inventory, where it's got a much shorter shelf life and therefore lower value, it's actually going to have a different economic impact. It's going to be different economically. So that would justify putting that into a separate class. And therefore, if you're putting all of your very short-term stuff that you receive into a separate class, then that's going to give you, effectively the same accounting. You can use your existing models of first in, first out, or weighted average to value that, but it will be taking account of the fact that it's got that short shelf life, the values will be lower, and therefore you don't have to sort of mix it up with the longer shelf life items. Keeping it separate will effectively give you the same benefits as having a separate model.
And might you, for example, if an NPO had lots of a few different classes of inventory, could you, in your accounting policy, rather than having one accounting policy that counts for all your inventory, you might have a slightly different approach, or you might say, we're going to take advantage of this exception for this class, and we're not going to, so if you're taking advantage of the exceptions in the guidance, you could apply it to a specific class of inventory rather than to the whole lot.
Yes, you can apply. Yeah, it will be applied class by class. Mm-hmm. So when you're looking at it goes back to the revenue recognition, which we talked about in yesterday's session. That exception not to recognize revenue immediately or at all for these items is based on the class of inventory. So it would mean that purchased if you've got your purchased vaccines, long shelf life in one class, and your donated vaccines, short shelf life in another class, then you could apply the exceptions differently to those two classes. You might
Brilliant.
choose.
So that just gives us a really good way to be flexible and applicable and appropriate to what we've got. So I want to bring us on to a different question that was submitted, which is about, and it's there in the video, about work in progress. Now, I have to confess, when I think of work in progress, I think of a manufacturing, I think of making stuff and it's work in progress, and then you get finished goods. And so how does work in progress even apply in the non-profit sort of context? Can you give us a couple of examples maybe that would root this in something that feels relevant for our sector?
Yeah, so I think this generally becomes an issue more for donated services, but in many respects it's the same whether it's donated services or services that employees are providing, work that employees are providing. Most of the value that is provided through donated services or through the work that staff do is used immediately. So you get the MPO gets the benefits immediately, and so it recognises an expense immediately. But there are some cases where actually that benefit is going to flow to the organisation over time. So you have a construction project, you have volunteers helping with that construction project, maybe architects providing designs over time or whatever. That's going to become part of the value of the asset, the building that you're constructing. So rather than recognise an expense, you treat it as part of the building costs. And then for inventories, you may have you may have leaflets being designed. You're going to get a stack of leaflets that you're going to use over time. There'll be printing costs associated with that. Those leaflets are going to become inventory. If you've got volunteers or staff contributing to the design of those, writing the text, again, that would potentially be work in progress. It would be part of the cost of inventory for those leaflets. And then the third item is where the only thing you're providing is the services, but those services provide benefits over time. And a good example is where you have NPOs working with refugees or other disadvantaged groups, providing legal services, and you need to prepare a case. That case is going to maybe occur 6 months after the end of the financial year, but you need to start producing the work, preparing the documents now. That typically would be treated as work in progress. It's the way that legal firms would work. They would build up work in progress from their staff working on a case, and then recognise the expense when the case is completed. So potentially that will be the same for NPOs working with refugees or the disadvantaged groups, building up cases for their clients, their service recipients. So you would build up the time. Without applying an exception, you would record their time, treat those costs as work in progress, and then when the case was complete, recognise the expense, because you then use the value of all of that preparation, and that's again quite challenging to record all the time, whether it's from volunteers or from staff. Put a value to that, particularly from the volunteers, and keep records for that as to how that time links to individual cases, when those cases are settled, and when you should recognise an expense. And so that's again why we think it's appropriate to offer an exception there that says actually for this work in progress, if you choose to, you can just recognise the costs as an expense as they're incurred, rather than having to set up time recording, case management, etc., which for many MPOs is probably going to be challenging, maybe beyond what their current systems are capable of.
That's really interesting. So yeah, so it's probably only going to be applicable to a small number of MPOs that actually have this type of work. But if you are in this type of work, then the proper application of IFRS would be quite a lot of complex accounting, building up work in progress, assigning staff time or volunteer time to these cases, as if it's going to be on the balance sheet at the end of the period, and yet you're not going to sell it. So like, what value is that bringing to the whole thing? Hence the exception. let's just not do that. Let's just expense that as we get it rather than considering it part of work in progress. So you're really kind of bringing in this real world, realistic, pragmatic approach, so that exception means that you don't have to go through all of that, which I think is really good. Okay. Now there's also why well, no, I think we've probably covered that already, so I think we're good. I think we're good there. So I wanted, are there any other questions in here that I've missed? I don't think so. So I think that's all the questions that I had. I hope that if there are other questions that people have, please do put them in the chat or keep the conversation open. We will be having conversations on these topics in LinkedIn and in other spaces. I hope this has been helpful for thinking how you would apply this in the context of NPOs that you know. I want us to finish the last few minutes with telling you how to submit your responses. So really, I mean, it's been really, really interesting to hear the sorts of questions and the types of issues and the ideas that have come out of this conversation. So we really, really do value your input. It's so important. So if you do intend to submit a response before the 15th of March 2024, it'd be great if you could let us know. There's a little form, short form that I think Brian is going to put in the chat. All that does is it lets us know that you do intend to be part of this formal public consultation process. If you want to do that, this is how. So step one is to go to the website, the Have Your Say page on the website, and download the response template. It's available in English, French, and Spanish. And the first little section is where you put your own details. Save it to your desktop, whatever, so that you can open it and fill it in as you go along with familiarizing yourself with the proposals. Step two is to form your opinions. You can do that by watching the videos, reading the documents, of course, attending webinars like this, participating in outreach events. And as you go along, record your thoughts in that template. It's structured according to the sections in INPAG, not necessarily most important first. It's just like, you know, section 13 is inventories. It comes in order of those section numbers. And there are questions that the TAG have prepared that they're particularly keen to get feedback on. But if the thing you want to say doesn't relate to a specific question or doesn't even relate to a specific section, don't worry, there's a separate question at the bottom where you can really have a free form feedback opportunity. You don't have to answer all the questions. Really focus on the areas where you've got a strong opinion, and that would be the most productive. And then when you're ready ahead of the deadline, you just upload through the website. Hopefully it's very easy, and we'll be here to help if you need it. In terms of what's next, we're in ED2, Exposure Draft 2 at the moment. Exposure Draft 3 is in production. It's work in progress, to use the right word, I suppose. And expecting to release that at second quarter of next year. That will cover topics like fund accounting, classification of expenses, fundraising costs, fair value, as Paul mentioned, and also a new volume, which the name isn't finalized, but something like a recommended practice statement for producing project-based or grant-based reports or specified set of activities. So watch this space. It's going to be really exciting what's coming out in ED3. We're still on track to publish in mid-2025, ready for adoption and use. That's the plan. So with that, let me say thank you again to Paul for all those nasty questions I threw at you. Thank you so much for the time that you've taken today. Thank you to each of you who's spent the time joining us today, and for those of you that are watching on the video. Please, we want to stay in conversation, keep sharing your opinions and views. It's really valuable for us. So with that, I'll stop. Thank you so much. Have a wonderful day.